whether free lunch was the draw or long-term perspectives were, but I'm glad to report that while we're in a position where we can't buy free lunch, we've got about 4 times our average attendance on the call, with 114 people signed up for this webinar. So we're really glad that all of you joined us. I think that number is a product of what the markets have dealt us. I mean, every day we've got historic news, historic information, and for me personally, I walked out of a CEO roundtable meeting last week where I learned that the cost of news ads, so just a vanilla 30-second ad, but during the news, actually was up 300% from normal levels. And I made a call, actually 2 calls, one call to Randy Rush, our chairman and founder of Integrity, and said, well, geez, if people are watching that much more news, there's just a perspective that we need to bring to the table, to bring to our clients, to just balance the perspective. Because while you can get information, you can get data, you can get timely information from the news or from a social media post, there's incredible value at moments like this to just kind of step back and consider long-term perspectives. And while it takes longer than a 200-character tweet or a 200-word article in the media, I think you will all benefit from just the wisdom that's gleaned over a 45-year professional career. So that was the first call I made after walking out of that CEO roundtable meeting. The second one was, I thought, man, who better to pair kind of long-term wisdom and having been through these types of market conditions over 40 years than Jason Ackridge, our Vice President and Vice Chair of the Investment Committee. Because what we want to do here today is pair kind of long-term wisdom and perspectives with just tactical. What can you actually be doing that's productive? I think all of us find ourselves in a position where we feel like we should be doing something, and if we turn to Facebook or CNN or Fox or your pick your outlets, chances are you're getting information that may actually be detrimental to long-term decisions as opposed to productive for long-term decisions. And so Jason's going to kind of take us through several things that can be done to really maximize the opportunity that the markets have given us at this time. And before I hand it over to Randy, just wanted to mention, I just want to recognize kind of where each of you potentially are in the audience. Just this morning, I read in the Wall Street Journal, the CEO of Nike said, "We've seen the other side of this." And of course, that caught my attention. And I read the rest of the article, and basically what he's saying there is that in China, Nike has actually already seen the other side of this. They're down to 0 cases per day for the last several days, and they've had this just kind of bounce back boom in China sales of Nike apparel and shoes. And you contrast that, and some of you that maybe already are sitting in a place where you feel like you can see the other side of this, to a client I spoke with in Europe this morning. We were just doing a quarterly review, and her husband had just been fined $130 for 130 euros, for taking a bicycle ride more than 1 kilometer from their home. And was just, the view was, well, geez, what can possibly be done? Her view is, what is there even to talk about this morning? And I said, well, actually, there's several things. And by the end of the call, we had outlined 5 steps that actually made a whole lot of sense for her to take. So I am so pleased to have Randy Rush, Chairman, Executive Chairman, Founder of Integrity, here to share those perspectives, to have Jason Ackridge, Vice President and Vice Chair of Investment Committee. And Randy, I will turn it over to you.
All right. Thank you, Eric. I'm actually going to have 2 different portions for this. One's an intro, and then after Jason, I'm going to have some summary. But thank you for everybody for participating. It is very interesting times right now. And what I want to do is share a perspective. It started back in November when I spoke to the university and talked about lessons that I had learned that I wished I had known when I was younger. And I'm going to piggyback off of that and talk about those things right now. And so you see up on the slide on the screen right now, one of the ending slides that I have, not all of them, but uh, little did I know that the very first bullet there that says there will be another crash, given enough time, the market will recover. Well, guess what? 4 months after that meeting back in November, it all of a sudden has come in a fast and furious time for us. Other things that lessons that I learned is that I wished I had started at the age of 5. I think I'd shared in that 1.5-hour presentation that I actually started at the age of 11. Lesson, when the stock market is down 10% from the high, invest, keep balanced mind, mental toughness, be efficient. When the stock market goes down 20%, these are just some of the lessons we talked about. The thing I want to be very sure to convey to you is that, like everything else, you can learn all these lessons, but if you don't apply them and you don't use them, the lessons aren't learned really. And so that's kind of what I'm going to talk about. But before I do, I want to give you a little bit of context. So Larry, if you'd go on to the next slide. I've been doing this for over 45 years. I can't believe I'm that old. But I was listening yesterday to a Texas advisory firm sharing, and their expertise had been 25 and 30 years. And I realized they did not participate or go through the 1987 Black Monday. Next slide, Larry. During my 45 years, I added them all up. I've been through multiple interest rate bear markets. I have been through 15 stock market corrections, 6 stock market bear markets, and I'm real briefly going to talk about Black Monday, long-term capital, the dot-com bubble, the Great Recession, and of course, what we're in now with the 2020 coronavirus, COVID-19. Real quickly, next, going through these slides, I've put at the very bottom the market decline, how long it took that decline to take place, and that length of recovery to come back to where it was before the decline started. Black Monday was a very interesting day for me. I came into the bank. I'd already been through a lot of other instances, but nothing like this, where in one day the market was down over 25%. And I had clients that I was managing money for. And, quite frankly, I had never seen anything like this before, and I wasn't that old. Let's go to the next slide. I'm going to rotate through these fairly quickly. Then in that same year, interest rates were rising, so there was an interest rate bear market. Next. And next slide. Then later, after we had a long, good recovery and good 10 years of good market performance, we had long-term capital. There we had a 15% decline. It lasted for 2 months, and the length of recovery only took 3 months to come back. That's what I would describe as a V recovery, and we'll talk more about that in a little bit. On the next slide, we're going to be looking at the dot-com bubble. The point on these slides I'm going through is that every single time an instance like this comes about, we've never seen it before. I'd never seen a one-day drop of 25%. I'd never seen where multiple smart people brought down the market. Here's where the dot-com, most of you know that the new dot-com rage was just going straight up, and then all of a sudden the bubble burst. Every single time in my experience that I've been through this type of market, it's something new. It's something nobody has ever seen before, it seems like. Next slide is, of course, where we're talking about the Great Recession. Most everybody that's on the phone will recognize and went through that. It was a 51% decline in the market. The decline lasted for 16 months and the length of recovery was 37. Again, had never seen a real estate recession like we had, where prices were dropping and everything. The reason I'm going through this, next slide, Larry, is, and these are just the averages. Median decline is 34% since the post-World War II. The duration's 14 of the decline. The recovery takes on average 40 months. I was on a call with actually it was a social worker the other day, and somehow we got into the discussion about her retirement plan, and she's a lot younger than I was, and she was just lamenting about how these are times that we have never seen before. And I literally, I said to her, well, I may not have seen these actual events, the pandemic and the shutdown of economies and everything, but I have seen multiple occasions where the market has had significant declines, and I can tell you it always comes back when given enough time. And that is why, for me right now, these are opportunities. It's difficult. I actually have firsthand experience of friends who have died from this coronavirus. I have extended family who are impacted by it. And so I don't take what is going on lightly out there, because it is impacting me and my friends and things. But from the lessons that I have learned, I know that there are opportunities now that we can take advantage of. And what I'm going to talk of later on after Jason is the things that I'm doing for the lessons that I've learned. Next slide. You know, I'm going to go through real quickly some of this is another slide that I have back in November. You know, bear markets can be violent. Wow, is that an understatement? We've had a 35% drop since February 19th. I would talk this as a very violent decline. The volatility and the number of days of 4 to 6% volatility is just unheard of. Haven't seen those things before. Next. Fear dominates the bear markets. And fear is basically when you don't understand what's going on and you don't have rock solid lessons that you have learned that you can't anchor yourself into. Next. There will always be a reason for others to stay out of the market. Back in November, I had, I think I went back to 1928. Every single year, there is a bad economic event that is a reason for you not to be in the market and invested. That'll always be there. And what hasn't changed is the fact that you have people who feel that way, and the fear overrides their best judgment and things. Next. We saw with the long-term capital, even the smartest and brightest do not guarantee successes. Next. One of my messages for me and for anyone else is emotions are hard to see in oneself when you're in the middle of dealing with them. And unfortunately, emotions do not make good investment decisions. They just don't. And so you gotta ground yourself in good lessons that you have learned or you're learning from other people. You need to follow those lessons in times like we're experiencing today. And then you need to surround yourself with other people who you trust, in good counsel to oneself, and good advisors, good legal, good tax advice, and everything is very, very important. And then the last line is be prepared to invest at a time of crisis and market crash. And that's what I'm going to be talking about here at the last portion of mine, is things that I am doing on the lessons that I learned. Because again, to repeat something I said earlier, it does us no good to learn all this if we don't apply it during these times. The next slide is, I want to make one point before I turn it over to Jason, and that is what I have learned over my 45 years is I don't want to do anything or invest any of my money or anyone else's money on things that I have to make the right prediction. In the case of this recovery that I know we'll have at some point in time, we don't know whether it's going to be V-shaped, meaning we dropped from February 19th down, and on Easter, we open up everything and the recovery comes roaring right back in the third quarter. We don't know whether it's U-shaped, where it takes a while for the recovery, and then in the third and fourth quarter, or it's L-shaped and we languish a while for people to get out. I don't know. I don't care to try to predict. My history is I cannot time the market. There's been opportunities to see what's coming, and my experience is if I have to predict something to be successful, it's not a good strategy. What I have learned is that upon these lessons that I went through a little bit before, is that I don't have to be right on a prediction. I just need time. And I am convinced that time will get us through this. Time will bring a recovery back to what the highs were leading up into this. And so how do we take advantage of those things without trying to predict anything? And so that's my lead into where my 45 years of experience are coming from. I'm going to turn it over to Jason, let him talk about what's going on within the wealth management department now. And I'm going to finish up the things that I am doing on the lessons that I've learned. And hopefully some of those will be important to you and you can take advantage of those. So Jason, it's all yours.
Well, thank you, Randy. Great history, and looking forward to some of your summary statements at the end. As Eric and Randy mentioned, my name is Jason Ackridge. I'm in my 21st year in the industry now, which feels like a long time. I'm a certified financial planner, a certified wealth strategist. So I've been managing money for a long time, building portfolios, building financial plans. I absolutely love what I get to do on a day-to-day basis for a living, including during challenging market environments like what we're in the middle of right now. So today, as the title of this slide suggests, I'm just going to take a little time and talk about smart money moves to make right now. I'm not going to dig into any of the COVID-19 details. We've all been bombarded with enough data that we won't dig into those details. But what I will talk about are briefly, where are we today? Where are the stock markets today versus the peak back in February? I do want to touch a bit on emotions. Randy alluded to that. No matter if you look at a market pullback as a positive or a negative, the emotions you feel generally lead to a reaction of, quote unquote, I've got to do something. So we'll talk about that for a little bit. And then we'll dig into strategies that we are implementing for our clients to do good things for their portfolios during a market pullback like this. So for those of you that are on the webcast and are able to view the slides, this first chart is a chart put together by JP Morgan, and it's providing return details for the S&P 500 index. Now, for those of you that may not be familiar with the index, the S&P 500 index that gets quoted a lot, it really is just a benchmark or a measurement tool that combines the largest by market cap 500 publicly traded companies in the U.S. So they put them all in one bucket, and then we take a look at overall. We can analyze what kind of returns those companies have done overall, what kind of dividend income they generate, what's the volatility. So it's a good benchmark for what's going on in the stock markets. So from this chart, if you start on the left and look at the kind of the jagged line up and down and work your way to the right, you can see starting in 1996 through the bursting of the tech bubble, the S&P was up 106%. And then from that point until the end of that time, which was October of 2002, the S&P dropped 49%. And you can see an increase from October 9th of 2002 through October 9th of 2007, an increase of over 100% again. October 9th of 2007 was the beginning of what we call now the Great Recession. from that point until the end, which was March 9th of 09, the S&P was down 57%. And then we see this long-running bull market from March 9th of 09 until February 19th, just last month. And the S&P was up over 400% over that time, longest running bull market on record. Now, logic might suggest that people will think that surely stock prices were well out of bounds. But just keep in mind, during that 400% increase, companies became more and more and more profitable. Earnings were better, dividends were increased, and so from a valuation perspective, stocks never got too far out of line. But then we get to February 19th, just last month, and at that point, the index value for the S&P was at 3386. We peaked. From then until just the end of last week, Friday, March 20th, as you can see on the far right side of this slide, we had a drop of 32%. So over a 30% decline in 30 calendar days. That was huge. What about international stocks? If we go to the next slide, we show the same data for the S&P, almost exactly the same time frame. But now if you look at the purple jagged line, that represents stock prices, companies outside the U.S. And so international companies overall were down 30% over that 30-day time frame. And so international markets were not spared, just like they struggled just like the U.S. markets. And so we all know that. So why is that? I mean, obviously we've got the issue with the virus, but we also at the same time had some activities in the oil markets. And so oil prices have dropped dramatically as well. So those two things combined have caused a big pullback in the markets. Some of that has been fear-based selling, no doubt. Some of that is caused by automated program trading. But keep in mind, ultimately, stock prices are a function of future expectations for a company's earnings, their dividends, profits, etc. None of us know yet the true impact of the oil price issue or the virus, and so we're not quite sure where these data points are going to land. So stocks, rightfully so, are not worth as much today as they were just 30 plus days ago. So have they been oversold? We don't really know yet. All we know is price-wise, they're a lot cheaper now than they were 30 plus days ago. And by some financial metrics, by some valuation metrics, stock prices are now well below their 25-year average. So let's talk just for a minute about the emotional side of investing. Money is personal. We all know that. Money evokes emotions. And it evokes emotions not just during big market pullbacks. It evokes emotions in a variety of different situations. Now, when we talk about the emotions, especially during market pullbacks, it generally leads to, as I alluded to before, people wanting to take action. And that doesn't actually depend on if they're just fearful. Even people that look at pullbacks, again, as an opportunity, just the same as people that look at pullbacks as something to be scared of, again, it all leads to, for most people, it leads to the thought of, I've got to do something. So let's just look at a couple of the emotions that I have watched friends and clients deal with over the years. So unfortunately, for those of you that can see the slides, this gentleman is now in the fetal position. He has struggled to deal with the bear market. So I have had friends and clients that have responded emotionally this way. And for clients, an example could be a client that, and I have no clients in integrity now that have done this, but I have had clients in the past. Their comment to me is, I don't like what's going on, even though you told me this might happen. I just want you to fix it. I don't want to look at my statements. I just want you to fix this problem. And so they avoid things for a while. Another emotion. I love it. This guy has decided he is going to manhandle this bear market and by sheer will force things to become better. So what are some examples of this? I've had friends in the past that have gone through a bear market and they just feel like, again, they've got to do something. And unfortunately, they've done things that are in almost all cases detrimental. Examples could be, I've had some friends that decided they're going to become day traders. Yes, they bought 6 or 8 computer monitors, set them up in their basement, and they watch charts and technical data throughout the day and try to buy and sell things to make small profits. Or I've had other people ask me or try to implement very complicated, very expensive option strategies, usually to their detriment. Or I've had people ask me about stop losses. They get so scared about seeing the red numbers in the markets that they want to put stop losses on really anything that moves. And unfortunately, during this tough time, the sales of permanent life insurance and annuities will probably spike. Now, I'm not saying they're wrong for all people, but in some cases, the expenses, the protection they think they're getting are not actually what they'll end up receiving years down the road. The last emotion that I would say is a positive, I like what this woman is doing. She is not scared of the bear or the bear market. She is making it work for her. So given my time in the industry, again, I've worked with clients through the dot-com bubble, through the Great Recession, and now through what we will probably end up calling the virus recession of 2020. And I've seen it time and again. Whether an investor views pullbacks as an opportunity or something to be feared, they want to do something. And we, as wealth advisors at Integrity, actually agree. We agree that something should be done. But it's important that the things you do are positive, things that will be a benefit to you down the road, not something that will be detrimental to you. So what I'm going to share with you today, as far as actions you can take and one that you shouldn't take, is really a description of what we're doing for our clients right now, okay? And these actions are not just for our clients that are wildly financially independent. These are actions we're taking in almost all portfolios, and they are for clients in all stages of life with varying levels of wealth and financial independence. But I'm going to caveat, before we go into this data, I'm going to caveat this by saying that every one of you on this call has a unique situation. None of us have a financial situation that is exactly like anyone else's. So again, when I'm sharing these actions for you, this is not specific advice to your specific situation. This is what we're doing for our clients and what we fully believe will be beneficial for most investors in this environment. So with that being said, let's talk about some smart money moves to do right now. And actually, before I talk about that, I feel like I want to just pass on some praise to our team here at Integrity. We have been doing a lot of trading, things that will be a benefit to our clients in the long run over the last 30 plus days. It has been a tremendous amount of work. So I just want to acknowledge Raider, Jeremiah, Gina, Jeremy, and Brianna. I mean, what a wonderful team with all the work they're doing. And we are doing things now that are going to benefit our clients for a very long time. So from this slide we're looking at now, one of the things you can do, we are not doing this for our clients, but one of the things you can do when the markets pull back is sell out of your stocks and sit on the sidelines. All right, this is not our recommendation. The challenge is, how do you know when to sell? The second part of that guess is, how do you know the right time to get back in? Selling out of stocks and sitting on the sidelines until things, quote unquote, feel better, that is market timing. And market timing does not work. Now, an investor that tries to market time, they might get lucky once or twice and they might guess correctly, but there are much, much greater odds that the investor is going to harm themselves more than help themselves. So the chart on this page, we're looking at the S&P 500 index, again, a proxy of what's going on in the markets. And the bar on the far left side shows the returns provided by the S&P over a fairly long time frame. This is the time frame 1990 through 2018. That's 29 years. Someone that invested $1,000 at the beginning of 1990, at the end of 2018, would have $13,000. That's annualized returns of over 9%, right? A wonderful time to be an investor in the S&P. That's on the far left side. If you move 2 bars to the right, we see the impact of missing just the 5 best returning days for the S&P over that 29-year period. This is not the best 5 days per year for 29 years. This is the best 5 days overall for 29 years. If you missed the best 5 days as far as returns on the S&P over 29 years, your return drops 1.5%. You're no longer above 9. You have an annualized return of 7.75%. Now, missing out on 1.5% returns may not seem like a lot, but over 29 years, it makes a massive difference. Your $1,000 doesn't grow to $13,000 like if you were fully invested in the S&P. Your $1,000 only grows to $8,700. So it's a big impact of just missing the 5 best returning days in the S&P over 29 years. If you move then 2 bars to the right, you can see the impact of missing the 25 best trading days, the 25 best returning days in the S&P over that 29-year period. Your returns are barely over 4. You get less than half of the returns of staying invested or being invested over that full time frame in the S&P. In fact, your returns are barely better than owning Treasury bills. Keep in mind, selling out of the markets, sitting on the sidelines, trying to guess when to get back in is market timing. It doesn't work, and just missing a few of the really good days in the markets can be detrimental to your long-term financial health. So let's talk about what things we are doing for our clients right now in their portfolios. Number one is staying invested and actually rebalancing. Now, to fully describe this, I need to talk for just a minute about what asset allocation means. Most of you probably understand this, but I want to make sure. For our clients that we consider balanced investors, we have an allocation target for them to roughly 60% in stocks or aggressive things, 40% in bonds and cash or conservative things. That, at its most basic level, is an asset allocation, a balanced asset allocation. If from the peak on February 19th, our 60-40 clients, if we did no rebalancing between then and now, those 60-40 clients would now be roughly in the 50-50 camp. Their stocks would now be only worth 50% of their total portfolio, and their bonds and cash would be up to 50% from 40 in their total portfolio. Right? That's a meaningful difference. So when I mention the word rebalance, what that really means is trimming bonds and cash from 50 in my example back down to 40, taking those proceeds and buying our stocks from 50 back up to 60, staying near our targets. Now, why is that helpful, or why is that a benefit? One, there's no emotion in that decision. We are strictly staying close to our targets. Keep in mind, when the stock markets really struggle, typically the most conservative parts of the bond markets do very well, especially treasuries. So when the stock markets do poorly, typically the most conservative parts of the bond markets do well. So when I talk about rebalancing, selling bonds, trimming cash, and buying stocks, what it's really leading us to do with no emotion is selling high, in this case bonds, and buying low, which in this case is stocks, which is a very good strategy for the long term. What I want to talk about on the chart on this page very briefly is to answer the question that I get from time to time. If I stay invested, which is scary when the markets pull back, how long is it going to take me to recover? So there's a lot of things going on this chart, but I just want you to focus on the light blue line. That is a 60-40 or a balanced portfolio. We're going to use the Great Recession as an example of how long it could take to recover. And keep in mind, the Great Recession was the second worst market environment only to the Great Depression. So the far left side of this chart, the light blue line, is where things stood at the beginning of the Great Recession, October of 2007. From there through March 9th of 2009, a dramatic drop in all portfolios that with equity exposure, including the 60-40. So from March 9th of 2009, how long did it take to recover to the starting point of the Great Recession, October 2007, for a 60-40 investor? It was about 18 months, about a year and a half. For more conservative investors, and in this chart, it's using a 40-60 mix, so more conservative, the recovery time was 8 months. Now, I'm not saying that those recovery times are immediate, but it's a lot shorter than what most people think. So right now, again, one of the things we're doing for clients, we're staying fully invested, and we're rebalancing and staying close to those target allocations. Another thing we're doing for clients right now is investing extra cash. Now, I'm not talking about emergency cash reserves. Those should be left alone. But for clients, our clients that have had a liquidity event or they've been sitting on extra cash for whatever reason, we are putting that cash to work within their target asset allocation. Now, why would we do that? Well, let's look at the data on this page. On the far left side, we look at the impact or the returns on a 60-40 or balanced portfolio after quite a few different dramatic pullbacks in the market. So on the far left-hand side, we're looking at the October 1987 market crash. From that point forward, after 1 year, a 60-40 investor is up 19%. 3 years later, they're up 33%. And 5 years later, they're up 76%. If you work your way across the chart, you'll see a variety of different bear markets and market crashes and the 1, 3, and 5 year returns afterwards. I'm not saying that we're at the bottom right now, even though yesterday and today are so far very good days in the markets. But it does seem like now could be a great time to put extra investment cash to work for long-term investors. Sometimes we get the question from clients and others, if I have cash I'm sitting on, should I put all that cash to work right now, or should I step into the markets over time? And I've got a two-part answer for you. And this chart is showing something called dollar cost averaging versus lump sum. The calculator would suggest you put extra cash to work right now. On average, 2 out of every 3 months in the stock markets are positive. But I can share with you stories from the past where friends have decided to put all their money to work and they see the markets go down for the next 6 to 12 months, and it's very disconcerting. So I can share with you from an emotional perspective, it's probably better to step into the markets over time. We have some clients right now that, again, are sitting on extra cash, and so we've been stepping into the markets over time. Dollar cost averaging is simply taking your total balance of cash that you want to put into the markets and deciding on what percentage of that you want to put to work over a regular interval. So again, calculator would suggest put it all to work today. Emotionally, it's probably better to step into the markets over time. All right, so the final 2 points I want to make about things we're doing for clients, I'm going to get a little bit technical, so please hang with me. What we have been doing for a long time and continue to do for our clients is something called asset location. All right, so don't get confused. We've already talked about asset allocation, but now I want to talk about asset location. So this chart attempts to give you a pictorial representation of the differences. Asset allocation is simply blending together a variety of different investments intelligently in different percentages to provide the best return for a given level of risk. It answers the question, what do we want to own? Asset location is a decision on where we want to own those different types of investments. So asset allocation says what to own. Asset location says where to own it. And that asset location is primarily trying to reduce tax bills, but there's also in some cases an estate planning aspect to it as well. To really talk about asset location for a minute, let's talk about the 3 different major types of accounts, of investment accounts. You have investment accounts considered tax deferred. So in your mind, think traditional IRAs. For most people, the money that was put into a traditional IRA has not been taxed, and the growth on that money has not been taxed. You can invest, you can do what you want inside a traditional IRA, and in most cases, there's no tax implication. Taxes are charged when you pull money out of that traditional IRA, and so that's when taxes are paid. So that's one major type of investment account. There's another type called tax-free. Think a Roth IRA. Generally, the money that's gone in was after-tax money, but the growth will never be taxed, and withdrawals will never be taxed. The third bucket, the third major type of account, of investment account, is what's called a taxable account. Think of an investment account that's just in your name, or maybe a joint account in the name with your spouse, or a trust account. All right, activities, buying and selling, activities that occur in these accounts will impact your tax return every year. So from an asset location perspective, we like to own certain investments in certain of these 3 accounts. So I'll use an example of bonds, treasury bonds, agency bonds, high yield bonds, emerging markets bonds. The income from these types of bonds get taxed at your income tax rate. We consider that to be tax punitive, especially for those in higher tax brackets. So we like to hide our clients, to make sure our clients are not paying tax on that income by owning those types of investments within their traditional IRA, because those bonds can pay out as much income as they want, and there won't be any taxes paid on that. On the other side of the equation are stocks. We consider stocks to be very tax sensitive. The income that stocks pay out is considered dividend income, and the majority of dividend income is considered qualified dividend income. Qualified dividend income has its own tax rate. And in almost every case, it's lower than income tax rate. So we consider stocks to be very tax sensitive. So we like to focus stocks in taxable investment accounts. The third bucket, the tax-free, since taxes will never be paid on the money, we like to be extremely aggressive. So those accounts will also own stocks. So again, just to review this section, asset allocation answers the question what to own. Asset location answers the question where to own investments. At the end of the day, it does not impact your pre-tax return, but it absolutely, and in some cases dramatically, will impact your after-tax return. The final thing that we're doing for clients right now is tax loss harvesting. All right, so we're focusing on taxable investment accounts. As I mentioned before, buying and selling in taxable investment accounts can impact your annual tax return. Right now, we have clients that own stock investments. It might be individual stocks, it might be stock mutual funds, it might be stock exchange traded funds, but it's investments that have stocks in it. Because of the massive pullback over the last 30 plus days, in some cases, those stock investments are worth less now than they were than they were at purchase. So we have right now a loss, or what's considered to be a capital loss. If we sell that investment today, we can capture that loss. Why do we want to do that? Because those losses can be used to offset future gains. Think about if we're 6, 8, 10 months from now, or even shorter, if the stock markets rebound strongly, we may want to trim some stock positions at that point, take some profits, maybe replenish cash. When we take gains in the future, we can use losses we capture today to offset those gains. So it's a net tax zero in that circumstance. Now, a very logical question is, yeah, but if I sell a stock investment today at a loss, what if the markets rebound tomorrow? If the markets rebound strongly and I'm sitting on the sidelines, I've missed out on something that will more than supersede any kind of a benefit from tax losses. So what we do for our clients, on the same day that we sell an investment with a loss, we buy something similar. Not exactly the same, but similar. That way, if the markets do rebound the next day, we haven't missed out on those great returns. So here's an example. For someone that owns an S&P 500 index fund, the U.S. large cap market, we could sell that investment today and capture a loss. On the same day, we could buy a Russell 1000 index fund, which is different than an S&P 500 index fund, but it will give you primarily the same returns on a rebound. So we can sell the S&P fund, we can buy the Russell 1000 fund on the same day. We have banked a tax loss, that we've captured a tax loss, and yet we're not going to miss out on performance if the markets decide to rebound the next day. Now, you can't sell and buy the same investment to take advantage of this strategy. That's something the IRS calls a wash sale, and they don't allow that for capturing losses. So you have to buy something that's at least a little bit different than what you're selling. Another advantage of capturing tax losses, if you get to the end of the year and you have more losses captured than gains captured, then you have leftover losses. Up to $3,000 of those capital losses can be included on your tax return to offset income. And for clients, especially in higher tax bracket, that's a total home run. If at the end of the year you've captured more losses than gains, and you have losses left over after putting $3,000 on your tax return, those losses can get carried forward to future years and provide the same benefits as in the current year. So let me wrap this up. Some final thoughts on what we're doing for clients that could be beneficial for you. First, don't panic and sell out of stocks. We do agree that doing something in market pullbacks is right, but let's do things that are positive, not detrimental. We are having our clients stay fully invested, but we're rebalancing back to their target allocations, which leads us to sell high and buy low. We are investing extra investment cash into the markets within our clients' target allocations. We are continuing our process of asset location, which impacts tax returns every year. And because of the size of the market pullback, we are capturing tax losses, which will have a variety of benefits just discussed. Now, all these things that I've gone through can be complicated, can be challenging to implement yourself. If you are not working with an advisor, I would recommend that you at least entertain the thought. Now, there are a wide variety of types of advisors in our industry. I don't think there's any limitation on somebody putting financial advisor on their business card. So I would strongly recommend, if you are doing homework on an advisor, find one that is considered a fiduciary advisor. Fiduciary advisors are held up to the legal standard of always putting what is in your best interest first, your interest ahead of anybody else's. And make sure they are an advisor that's a fiduciary at all times. Not a fiduciary during some transactions and not in others, but a fiduciary that is in all cases and all transactions fully a fiduciary. That means you will primarily be talking to trust companies like Integrity Wealth Advisors or what are called registered investment advisors, or RIAs. So with that, I want to leave you with a couple of quotes. One from Warren Buffett: when everyone is scared, I'm buying. When everyone is buying, I'm scared. There has been a whole lot of fear leading up to this point. Another quote from Warren Buffett: the stock market is a device to transfer money from the impatient to the patient. Nick Murray, well known in our circles, a quote: investing is the age-old, never-ending emotional battle between fear of the future and faith in the future. A quote and a paraphrase from Oxford Financial Partners: a bear market is when scared investors who think it's quote-unquote different this time sell their stocks to successful investors who know that it's not. And then lastly, from Shelley Cullum Davis: you make most of your money in a bear market, you just don't realize it at the time. All right, with that, I'm going to hand it back to Randy, and thank you.
Thank you, Jason. I'm going to just take a few minutes to kind of take a lot of the things that Jason has said, some of the lessons I've learned, and kind of let the rubber hit the road, I guess. And so, sure enough, we have another crash. We're in the middle of it right now. I firmly believe, I have learned, the market will recover. We just don't know how long. Here's a couple things that I'm doing, and I think may be practical for you to consider, but always consult your own tax advice, your own advisor, your own attorney, to get how it applies to your own situation. The first thing I'm going to start with is my comment that I learned that I wish that I had started at the age of 5. Next slide, please. And here's my dad, Blaine, did this for my kids. It's what I am going to be doing for my grandkids. It is a very smart strategy that addresses this age of 5 comment. And that is, unfortunately, when I was 5, when I was 11, when I was 20, there was no such thing as a Roth IRA. A Roth IRA came in 1997 when they passed the legislation for that. But it is a very powerful account. It allows you to accumulate and grow tax-free on income that you've already paid taxes on. Well, think about your grandkids. I have 14 grandkids. The oldest one is just now beginning to work at McDonald's and making a little bit of money. I am in conversations with the family and going to be sending out paperwork to open a Roth IRA for him. He won't do it on his own. You know, he doesn't even know about it. So I'm going to tell him that if he'll send me each year how much money he makes, I will contribute that into the Roth IRA for him, on one condition: that he shouldn't touch it, that he lets it grow until years into the future. And so that is oh, hold on just a second here. Anyway, Larry, I've lost my my video here.
It's still broadcasting. We can see it, Randy.
Okay, fair enough. And so I'm going to open up a Roth account for each of the grandkids as they begin to work and make a little bit of money on themselves. And hopefully over time they will watch the investments and it will grow for them. And I'm going to challenge them to not use it and not spend it and everything. So that's one of the things that I'm going to help my grandkids learn how to invest at a young age. Following up what Jason was saying, when the stock market is down 10% from the high, invest. And I personally been doing that. When the market was declining, I had some money that was available for this purpose. It's not emergency money. It's money I can afford to invest in it. And I've been adding to my investments, just like Jason's been doing for our clients and for you and everything. Next line item is keep a balanced mind and mental toughness. I want to spend just a second on this because this goes with the idea of listening to chatter on the TV, on the radio, or wherever it is. Next slide, please. This happened to me over 20 years ago. I was reading in the Wall Street Journal about, they did a survey of interest economists who were predicting what the interest rates would be for the next 12 months. And in the middle of the article was a line that said 51% of the forecasters thought rates were going to be up, 49% of the forecasters thought interest were going to be down. And I thought, well, that's stupid. That gives nobody any good information. They're 50-50. Well, that realization 20 some years ago, that is really what a definition of a market is. When you're buying IBM or Apple at a certain price, there are just as many people who thinks it's going to go up as those who are going down, and that's what establishes the price. That is the same now. And so when, next slide, please. And so with that in mind, protect your state of mind. Don't let one person's comment on the radio, on TV, on CNBC, on whatever it is, don't let them scare you. I've got one slide here that came out of Bloomberg. On the next slide, please. Top economists see some echoes of depression in the US, sudden stop. I mean, you could just all of a sudden start freaking out and forget all of the lessons that you've learned and say, oh goodness, if we're going into the depression like it was back in the 29, 30, 31s and stuff, then I'm going to be that slide. I'm going to hunker down. I'm going to bring everything home and I'm not going to do any good. You got to remember that there's always the other side. The cup is half full. The cup is half empty. It's always that way. Even forecasters are that way. So protect your mind. Don't let these things get into there. Stay with what you know and what your experience shows you. And that's the best advice I can give. And that's what I'm trying to practice right now. Okay, I'm going to finish up with a couple other things that I'm doing. Next slide. And the next one again. Okay, be tax efficient and utilize Roth. I'm not going to spend much time on that, but I'm doing things that Jason has already gone over with you. Next piece. When the stock market is down, now this is my lesson learned. When the stock market is down 20% or more, consider traditional to Roth conversions. Basically what you're doing is saying, hey, I want to convert my traditional Roth IRA that in the future, when I take money out, I'm going to pay tax on it into a Roth when the values are the lowest and the tax brackets are the lowest. And right now, I have already converted part of my traditional IRA into a Roth IRA because the market was down over 20%, and I converted a lot of my equities that were in my traditional IRA into my Roth. And so a lesson I learned, but it's a lesson that I am applying now. And again, to do something of that consequence, you need your advice of your advisor, your tax accountant, and etc. Next one. Have an advisor you trust at your side. Even though I've had 45 plus years of experience, I have bought and sold millions of securities, whether it be stocks, bonds, municipal bonds, etc. Have an advisor you trust. I trust Jason. I trust Raider. I trust Eric. I am always bouncing off my thinking and my ideas with my advisors myself. You need to have the same people around you that can protect your mental toughness and things. Another thing that I've done, I have rebalanced my portfolios by selling some municipal bonds at good gains because they've been at low interest rates. They have done well, and I'm going to continue to dollar cost average into my equity portfolio with funds that I have available to do that. And so, okay, next slide. A big thing that I am truly convinced of is, as we have success in our life, whether it be with knowledge, lessons we've learned, or with finances, or whatever it might be, we need to be generous along the way. And for me, I want to continue to be generous now when times are tough. I want to be even more generous when times are a success. And that is the ultimate goal, that I want to be able to be generous to my family, my grandkids, my staff, the community, and etc. So don't let times like this take away your ultimate goal with all this. One more slide, and I'm going to be done with my part of this. One, remind ourselves that history is on our sides. This too will pass. The more things change, the more they stay the same. Consider opportunities to help your kids and grandkids to invest today, to learn, whether it's an IRA works for you or not. For me, I'm going to teach them how to invest and teach them how to put money away for the future. 529 plans, if you need to fund them, today's a great time to fund the education plans for your grandkids and kids and stuff. Rebalancing, another idea, don't wait till April 15th of 2021 to make your 2020 IRA contributions. You're missing out on a timing opportunity that I believe you would have now. So if you have the funds available, make 2020's contribution now in advance of the last deadline when you do your tax return. Of course, you got to visit with your accountant to make sure you're eligible to make those contributions and get good advice on that. Consider Roth conversions, and don't allow the moment, the things going on in the media and stuff, to change what you have established as a good plan. With that, in spite of the pain that is going on with the pandemic, the issues related with everybody perhaps losing jobs, don't know what the future holds, I am convinced that the market will come back, and these steps that you heard talked about by Jason and the things that I believe in will be beneficial to you. With that, I'm going to turn it back over to Eric, and thank you for listening to me ramble on. I've enjoyed sharing a little bit of my background with you.
Hey, Randy, thanks so much for that, and thanks, Jason. I mean, even as I'm sitting here, I'm familiar with the content, but wrote down 10 things that can be taken away from this presentation. We are going to open, make ourselves available kind of between the three of us for questions. For those of you that logged into the webinar, there's a little chat box where you can enter in a question there. That's preferable to trying to unmute all the lines and hearing babies or lawnmowers or, you know, coffee grinders in the background. But if you're not on there and do want to have a question, then maybe text to Larry Dozier at 719-510-1736. He's giving me the nod, and I'm giving him the head shake. While those questions start to spool in, again, Randy, thank you so much. I mean, to be able to bring 45 years of perspective and say, you know, while the circumstances are totally unique this time, it's not different this time in terms of the types of things that and ways that we can respond with wisdom in ways that pave a stronger foundation for a better financial future for everybody on this call. I will say integrity, it takes a team-based approach. So whoever your advisor is has these details and knows exactly how to put these things into practice within your own accounts and circumstance. And so Larry, Jeff, Rader, Jeremiah, Jason, myself, the client-facing advisors. We meet regularly to share best practices, and we've been bouncing ideas off of each other as we always do, but at a whole new level and pace here the last couple weeks. We have 6 certified financial planners on the team. We have over 100 years of experience collectively, and we're using that to help you make decisions that will truly better you rather than devastate you. Unfortunately, it's times like these where, like Jason said, that need to do something sometimes puts us into the ditch on either side. We're here to be an advisor. We are fiduciaries, which means we're not here to sell you something. As you can see, there's no like pitch for an annuity or something at the end of this presentation. We're just here to bring our perspective and to help you put it into practice. And wanted to share the stats too for those of you that are still with us. Looks like most of you still are. That across the accounts, we've actually already rebalanced in excess of 530 accounts. And if we just look at Friday's price, we don't know what's going to happen in the next 30 days. Anybody that tells you they do, well, they don't. I'll just put it that way. Trying to make this PG here for our audience today. So if it takes 3 years, and you saw the data, it can take 8 months, it can take longer than that. But if it takes 3 years from Friday's entry point, that's a 17% annualized return just on the equity side of your portfolio. Now, short term, if you use Friday as an entry point, you may feel like, that was a terrible decision 30 days from now. Or you may feel like, hey, I nailed it. I found the bottom. The market's already up, significantly so far this year. What our encouragement here is, while the news and social media is appropriate for kind of updates and quick, factoids, the types of decisions that will help you here are those that are anchored in long-term wisdom that are gained over a century of experience, and we're here to bring that for you.
I'm sorry, can you say the phone number again?
Yes, phone number is 719-510-1736. So there was just a administrative question of how to ask questions. So there's a chat toggle or a discussion toggle that you should be able to click from either your smartphone or your PC or laptop. When you click on that, there's a place to enter your message, and we can see that. You can direct it either to the entire group or to us as the organizer or presenter, and we'll collate those as those come in and go from there. Here's a question just came in. All right, I'm going to pass the first question that came in via text to Jason.
All right, so the question is, if I were to front load my 401k contributions right now, just want to clarify, you would recommend Roth versus traditional. Wow, this is one of those questions that really is different for every person. Taking into account tax bracket you're in today versus tax bracket you think you'll be in the future, and so that would be a great conversation to have one-on-one with your advisor. Sorry, I can't give you kind of a blanket answer to everyone on the call because it would be different for everyone.
it does sound like from a couple messages that have come in that the chat's either hard to find or not presently available. And so our encouragement is, we're here for you. Just to talk real quickly about integrity, we are doing social distancing. We are a financial institution, which is exempt from that. But in the abundance of caution, of course, this presentation's online. But we're here. We're working our tails off at the moment, just to be available, to have the resources and kind of curate the resources that will be helpful for you at this point. So reach out to us via however you normally do: phone, email, text. Our 3 client services associates are all here to help kind of organize and calendar appointments. We're all here taking appointments, taking conference calls. Of course, no one's on the road at the moment, so we're here and ready to help. So I'll just wrap it up with thank you for all of you who joined the call. As I said, our 100 years, our century of collective experience, our 6 certified financial planners. I mean, we're here to help you. And these are the times where we very strongly believe, high conviction, that we can redirect some of that need to do something into things that are strong, foundational, and fundamental, and can help build your financial future rather than potentially fall into the ditch on either side. So we'll wrap it up at that. Reach out to us. We're here, and thanks for joining us today. Take care.